quickly, really, really quickly. Let's create an alert here. We're getting right to it tonight. Now, I labeled this video or the live stream why I am buying puts on the triple Qs. And we're going to talk in great detail about the logic of as to why. We're going to talk about where I would be putting money, where we are putting money long. And I want to clarify from the outset, I am not shorting the triple Qs. I am hedging my portfolio. Big difference. I do not have a net short position. I don't even have a full hedge yet. But well, we're starting to come apart here. This is only a 1 minute chart. Let's pull back to a 15-minute. So we initiated our hedging operations on Friday. Very small one lot contracts of the Qs going out expiration June of 2023. It's what you call a bear put spread, meaning I bought a deep in the money put contract. I sold a deep out of the money put contract to help finance the trade because I don't necessarily expect for the Qs to go collapsing tomorrow. Now we're down a quarter percentage point. A lot of selling here. So it's early. If we have time, we'll circle back to the futures before we log off tonight. Okay. Let's go to some comments. Franklin, they are no joke, pal. No joke. Pete, how are you, sir? Plus the stacks. Been a while. How you doing, pal? Okay. Let's move on with the futures action. Let's check in with the S&Ps. S&P's outside reversal bar, 15-minute time frame, much like with the Nasdaq, that shot up higher, only to reverse. We have taken out probably the last hour's worth of lows of Friday, and we're pretty weak here. This is an outside reversal bar, also known as a bearish engulfing on a 15-minute time frame. Very volatile chart. However, if you're not familiar with what these terminology or what the terminologies I'm using, 5-part video tutorial, my 5 top favorite candlestick patterns. This is one of them, bearish engulfing. So Nasdaq under pressure, S&Ps under pressure. Let's stick with equities for a moment. The mid caps, very similar chart. We are down just shy of a quarter percentage point. All right, so we have an alert set up. Let's see what the VIX is doing here. Unlike the equity market or the S&Ps anyway, we didn't have a big gap down on the VIX and then a reversal higher. We opened pretty much where we closed on Friday. So you have the VIX up just shy of a percentage point. Let's keep going on here. Let's check in with the US dollar. Let's check out the FX markets. Dollar is up higher, fractionally, but higher. Let's check in with commodities. Gold, they took it down at the open. Now they're trying to reverse it. Let's see if we get higher highs here. And let's also get notified if we take out the lows. Okay, moving on. Let's take a look at silver. Do I have silver up? I don't think I do. I just saw it. I just saw it. I just saw it. Was it SL? Nope. There we go. All right, silver getting hit. Big short covering rally on Friday. Then it just traded flat. Ten-year yield futures gapping up higher. All right, so this is what we spoke about on the week ahead commentary with members. Folks, we're going to talk about this more in a moment. I'll show you the weekly chart of the 10-year yield. It's one of the factors that caused me to open up a hedge on my portfolio using, again, put options and going out their leaps to go out into June of next year. So I'm not really worried about time decay. So my big concern was that A, we were moving up and into resistance on the Qs. B, yields looked like they were ready to move up higher and gap up higher. We know that a three handle on the 10-year yield causes a lot of trouble for tech stocks. What populates the Qs? A lot of tech stocks. So that's why we went short of the Qs. And this is the NASDAQ 100, which is, for all intents and purposes, the Qs. All right, moving on to light sweet crude. Down about a half percentage point. We may be putting in a higher low here. They opened it down. They reversed it higher. We have a breakout 15-minute time frame. Let's see if we get a continuation move up higher. You get a continuation move up higher here, you're going to have a lot of the oil traders out there buying this up. You can see a squeeze happen. Okay. There we go. Let's take a look at agriculture, wheat. Let's go to the weekly charts on wheat and ag. Consolidating here. I think that we need to start looking at possibly putting on a long trade on wheat. You could use WEAT if you're not into futures. That'll put you long of wheat. You could sell puts against it, average your basis cost down. Lots of ways to trade wheat using options. So wheat appears to be consolidating. We have a lot of history of support down here. Soybeans, Soybeans had a very strong week the week prior to last. I would call this an inside week, but I think he actually put in a lower low, intra-week low, 1356.25. Yeah, we did. So we did take out the lows of last week, but we rallied. We're holding on to the support level. Again, another commodity where, and it's traded, I believe, on the Tetrium soybeans. You could sell puts on it and average your basis cost if you're interested. Corn prices consolidating. So the longer the consolidation, the greater the validation of any breakout. So it looks as though we may have a bottom in on agriculture. May. Let's just take a quick peek at the Japanese yen. And the euro. Because these have a big influence on our gold position. And I'm going to talk to you why in a moment about why you really need to be looking at gold, both from a fundamental basis and from a technical basis. So the euro is flat, the yen is flat. Let's just check back in with the dollar because, again, the dollar really dictates where gold is going. And the dollar on a weekly time frame had a very strong, let's get rid of all of this. The dollar had a very strong week last week. This is what you call a bullish reversal, and we broke out above resistance. So we have a breakout on the dollar. Now, if we break the lows of last week, this week, it's my prediction that the dollar is done. But that's a bold statement because it looks as though the dollar wants to move up higher, and that will put pressure on our gold trade. Come on, you can do it. You son of a bitch. Sorry, family-friendly show. There we go. Okay. Let's drill down a little bit deeper. 15-minute chart. Dollar pretty much unchanged from where we checked it out. Okay, let's get back to comments. Lois, hello, sir. TZ Burton, word of the day, recession. Yes, sir. How dare you challenge the regime and the new definition? Yo, Bob and the Contrarian crew. Yoga Mac. Yo, back, my friend. Okay, let's get to it. Again, if we have time, I want to circle back to the futures because they're really interesting tonight. Let's talk about valuations as we always do. The stock market, as measured by the Buffett indicator, we go into the new trading week overvalued yet again. Remember, it was about 2 weeks ago. We were fairly valued, yet we were still extended way beyond historical norms by about 30%. Now we're back to being overvalued, currently 40% extended beyond historical norms. What are historical norms? Right down here. Or 1.1 standard deviation move on the Buffett indicator. So we're expensive. The Shiller PE ratio, the mean 16.96 going back many, many years. And at current, we are at 31.10, nearly double the mean of the Shiller PE ratio going back many, many years. Trader Isaac, all that matters is you here, brother. Joe Gardner, evening, Bob, watching off and like. Thank you, my friend. Yeah, folks, if you could please smash the like button, subscribe, you know the deal. All right. So again, I want to reiterate, I don't like clickbait, but I did want to make it a bit shocking so people watch, but I did buy puts on the triple Qs this past week for a multitude of reasons. But being a technician, primarily, It was knowing the inverse relationship of the 10-year yield relative to the technology space and looking at the weekly charts of both and saying, wow, very bullish on the 10-year yield. The Qs, the closing price action of the Qs, very bullish candlestick last week. There's a problem, and we're going to go to it in a moment. It's not impossible to overcome, but let's talk about economic data. So last week, I think there's a lot of shenanigans afoot. So let's begin with August 2nd, we had job openings come out. This is important because before companies lay off, they shut down the openings of positions. So if they reevaluate whether or not they want to hire, and if they had an opening, they shut it down. Or if they were going to post for a position, they're not going to post for it. They'll do more with less. That's the big corporate phrase: do more with less when you're going into recession. So job openings for June, nearly 1 million jobs less than the prior month. Think about that. S&P U.S. Services PMI. How is the PMI measured? A read above 50 is a sign of expansion. A read below 50 is a sign of contraction. What did we get? 47.3. Slightly better than expectations, but still contraction in services. And we don't produce as much as we used to. So while we had a good read on the ISM, where was it? Oh, that was from the prior week. ISM manufacturing came in strong and above 50. It doesn't offset the services. So keep that in mind. Initial jobless claims came in as expected, still hot. Non-farm payrolls. Okay, the big headline number is that we beat by a mile. This is the, what do you call it? The establishment survey. There's another survey out there. We're going to talk about it in a moment, and it missed by a wide mile. So let's talk about that a little bit. But before we do that, let's talk about what's coming up this week. We have CPI coming out this week. This is going to be the big number of the week. I think it comes in with a miss, a lower than expected read month over month. Year over year, it's going to probably come in higher. But month over month, it's going to come in probably lower. If it doesn't, this stock market's going to drop like a rock. But I think it's going to come in with a good number month over month, and that may be enough for equities to rally. So watch out for initial jobless claims. They're expecting 5,000 more initial jobless claims versus the prior week, and you're going to get the University of Michigan Sentiment Survey, a very important number. So that's the economic calendar from last week and what we're expecting this week. We have a lot of earnings coming out this week. I don't see a lot of earnings trades out there, really. Disney, So not a lot of stuff out there to trade this week, but we will be putting on positions, but we'll also be putting on hedges. All right, so the jobs read came out 528,000 in July. The swaps indicate, Fed swaps indicate we're going to have a 75-point basis point rate hike in September. They were expecting a 50-point basis hike, no longer. So this is a straw on the back of the stock market, because what the Federal Reserve is doing, I just shared with you the job openings. They're declining. Nearly 1 million less jobs available than the prior month. That's a lot. So the Federal Reserve is hanging their hat on their ability to continue to jack up rates by one jobs. Actually, you know what? Scratch that. Two jobs report, one from June, the other July. But one of the logical reasons as to why they were so strong is that you have a lot of job openings out there, but the problem is that you have people that aren't making enough money to buy groceries, to buy oil, to heat their homes. So they're getting multiple jobs. So full and part-time workers plunge as multiple job holders soar. So you have the people in the workforce are declining. Think about that. People in the workforce are declining. If you take a look at the quits number last week, This is a measure of the people leaving the workforce. They're quitting. 4.3 million in the month of June alone. They're dropping out of the workforce. This is with inflation moving up higher. So the Federal Reserve is looking at all this and saying, okay, you know what? We're looking at this. We're going to claim victory here. Our policies are working. The Biden administration needed a win going into the midterms. And you need to argue whether or not it really was a win or is there shenanigans afoot? Because when you take a look at the establishment survey, which is what we got on Friday, versus the household survey, different survey, you have a differential of 1.5 million jobs between the two surveys. So the establishment survey, again, which is what we got, 372,000 jobs created, a negative number on the household survey. I don't know. And that 1.5 million jobs is over a series of several months. That's why that's not just for July. It's over a series of several months. So I'll share this with everybody. There's a lot here. It's actually a really good article with some charts. So you may get some value out of it. I'm sensing estrogen in Patrick Hello, PLTR earnings tomorrow. There she is. Trish, too much male toxicity here. Thank you for being here. Hope all is well with you. Falcon, hey, Bob, if you pull up the VIX and scroll back to capture last November and draw a lower trend line every time we hit, we're going to go to the VIX in a moment. Yeah. I think the VIX is looking on a daily time frame, weekly time frame. It doesn't look good. When you take a look at it from a quarterly time frame and a monthly time frame, you're building a big base. Buster Stacks, the Fed is all about massive inflation. Yes, money supply, M2 money supply. It's all about inflation, which will wipe out the bottom 90%. The Fed will never allow deflation. Deflation would help any working persons or senior citizens retire. It would kill the top 10%. Yes, it would. Can we look at coal? It's dropping. If we have time, yes, see more rivers, we will. Hello, by the way. Okay, so leaving off here, if the household survey is more accurate than the establishment survey, and you have the Federal Reserve raising interest rates by another 0.75 basis point, you got to worry. You got to have a safety net on your portfolio. So we've been talking a lot about the dollar's strength, the Federal Reserve's balance sheet. We talk about the Fed's balance sheet. We're going to go to that in a moment as well here. The Fed's balance sheet was supposed to drop like a rock in June, July, August. It's come down, but ever so slightly, nowhere near what they promised. So I don't know how this gets financed because the Treasury has no money, but the Senate passes $740 billion tax climate. Think about this. The Federal Reserve is raising rates into a recession. I am not going to go with this Orwellian newspeak and use their definition of recession. We are in recession. We are seeing increases in the Fed's tightening of interest rates. You're also seeing the Senate pass a bill raising taxes on pretty much everyone. They say it's only on people over $400,000. From what I understand, it's pretty much on everyone. And they weaponize the IRS. The IRS is about to get twice the size of its normal size. In fact, here, the package includes provisions to address climate change, pharmaceutical costs. Pharmaceutical costs are going to bring down You're going to subsidize pharmaceutical costs. That's going to bring down the deficit. This is called the Inflation Reduction Act. So you're gonna subsidize medical medical costs. That causes prices to go up, just like they did with the college tuition when the federal government under Obama took over the federal loan program. What happened to the cost of tuition? It went through the roof. So whatever the government touches and subsidizes, it turns to mush. And you're going to have a supercharged IRS. $370 billion for climate change, the largest investment in clean energy and emissions cuts the Senate has ever passed. Wow. 3-year extension on healthcare subsidies. Again, this is going to add to the deficit. 15% minimum tax on corporations making $1 billion or more in income. Who pays for that? They're not going to pay for that. We're going to pay for that. It's a hidden tax on us. IRS enforcement. So the IRS is going to make sure they get their money out of us. They're not going to go after the companies making over $1 billion. That's too hard. 1% excise tax on stock buybacks. Oh, that's going to be great for the stock market. So the bill allows for tax incentives to purchase electric vehicles. So you're going to have tax incentives for people who are being taxed out of any type of a lifestyle to go out and purchase a $60,000 car. Okay. A car which carves massive, not even dense scars in the earth for cobalt, all the ingredients that you need for these batteries. The tax on the grid that these cars are going to cause. I mean, it's just insanity. And how is this going to get financed? It's going to get financed through the Federal Reserve. What happens to the US dollar? It should come under pressure. All right, so let's talk more about the dollar and the whys behind why we're probably going to be adding more to our gold mining trade, if not the gold trade, and not paper gold, folks. They can cancel those contracts. You do not want to own paper gold. You want to own the real deal. All right, so this was announced back in June of 22. The BRIC countries. What are the BRIC countries? Brazil, Russia, China, India, and South Africa. So this has changed in recent years, the meaning of BRICS. So they are creating their own currency. The countries together account for more than a quarter of the world's oil production, half of the iron ore production, 40% of the corn production, 46% of wheat production. This would give the new reserve currency a good start for a world economy. You already have Russia that is not opted out. They were kicked out of SWIFT. They're out. You have the Chinese, which are working very, very aggressively to get out of SWIFT. They have the gold, they have the Petro Yuan. They have their own gold trading system. And when you take a look at the US dollar as a percentage of trade, we were 70%. We made up, the US dollar was, transactions in 1999 made up of 70% US dollar transactions. Now, 59% in 2021. Think about that. And it's only going to get worse. As recently as, yesterday, Turkey agrees to pay for Russian gas with rubles. Let's check in with the dollar. The dollar is now lower. Good. Threats. And we're talking about the reasons as to why we're long with the gold mining stocks, gold, silver, and why we're putting on a hedge on our portfolio. And again, it's not a net short position, but if we wake up one morning and we see the Dow futures down 1,000 points, 2,000 points, and it's happened before, many, many times before. You don't want to go buying insurance when your house is on fire. You want to do it when the prices are low. The implied volatility on put options right now for the triple Qs, at 22%. Very, very cheap. So, geopolitical risk. North Korea willing to send up to 100,000 troops to Ukraine. This is probably not going to happen. It's probably hyperbole, but you can just see that the North Koreans are becoming more and more emboldened. They're doing a lot more missile testing. The regime here is weak. Therefore, the regime over there is getting bold. Taiwan, this is not going to stop. I think that you're going to see constant testing of the Taiwanese to the point where they try to break them psychologically, and then they'll go after them militarily. 20 total Chinese and Taiwanese warships in close quarter standoff in the Strait as drills wind down. You have the USS Ronald Reagan, they aircraft carrier battle group is in the area as well. I don't think that's included in this 20 count. Miscalculation could happen at any time. So this is the geopolitical risk that is on the table. Taiwan sends China's drills are simulating a full attack on the island. No joke. Thank you, Nancy. Now, here we go. You can't get rid of these guys. Here's Bob Menendez here. He's a Democrat. This is Lindsey Graham, Republican, a pox on both their houses. All right, both of them are no goddamn good. So these two never met a war they didn't like. So they are pushing to gut the one China policy that we've had in effect for 40 years. In short, they're trying to force the Chinese to take Taiwan. They want a war. They want it. Why do they want it? I don't know. I don't understand it. But I guess they're getting great donations from the military-industrial complex. A little bit about Bob Menendez, so you know exactly where his bread is buttered. Bob Menendez was taking week-long trips to the Dominican Republic. This guy here, Solomon Mengel, he was a big wealthy donor on the guy's private jet. He was charged with, I'll share this out. It's too much to go over. I don't want to get too long in the tooth here. In short, he was acquitted of felony counts, young girls, bribery. This guy is still in office, and this goes back to 2006. You can't get rid of these guys. I'm getting an error message here. Sorry, folks. Okay, let's move on. So, why are we concerned about the market? I frankly think that we could still melt up here into September. And then you're going to probably, if we see yields break out above a 3 handle going into the Fed meeting, you're going to see the markets begin to buckle. The price action of the 10-year yield last week was very, very strong. And we've been watching this setup form for several weeks now. I've been saying that we have a bull flag setup in the making. We tested the lower band of support last week, and we reversed off of it. It looks as though we are probably going to break out on the 10-year yield. So we know from past history, and I've repeated this, I'm going to repeat it again. Once you get over 3 handle, technology has a very, very difficult time rallying. In fact, it usually rolls over. Now, when you take a look at the triple Qs, this is a good looking chart, right? It's good looking. I like it. There's only one problem. After rallying off the lows from back in June, we rallied up around 20%. And where we stalled last week was at the upper band of resistance, the upper band of the declining downtrend channel. This is where you would normally, as a short, get short. You would open up your short position. So this is the other reason why we opened up a put position as a hedge only on Friday. Now, what am I wrong here? Well, if we break out above this upper band of resistance and we close the week out above it, well, then a couple of things has to happen here. We have to reevaluate. Do I want to keep this trade on? Well, if the 10-year yield goes through 3%, I'm going to keep the trade on. If the 10-year yield pulls back and we break out on the Qs above this upper band of resistance, I'll probably take it off and look for a rally up to 340 to reinitiate. It's way too early to make that determination. The markets are going to dictate, not me, the markets are going to dictate which way we go with this trade. Now, if we begin to roll over on the week, and by Friday, we're looking really, really weak on the week, pardon the pun, we're probably going to lean into the put position, adding more, dollar cost averaging in. If we begin to rally up and through 325 up to 340, and the 10-year yield is still going above a 3 handle, at 340, I'm probably going to double up on the position, if not add more, especially into the Federal Reserve meeting. Why else are we somewhat bearish on the market? The put-call ratio, I know this is a bit wonky, but the put-call ratio of puts versus calls, to keep it very, very simple, when the level of puts versus calls drops down below 0.80, get ready for a sell-off in equities. You could see here, we got down to 0.81 back in December, and everything went to hell in a handbasket. So where are we now? We closed at 0.86. So we're 5 basis points away from where we bottomed out back in December of 2021. So sure, we can head lower and the stocks can still move up higher, but we're in the neighborhood. We're probing those lows. And there's a lot of bullishness out there as well. Add to that, I forget who it was that brought up the VIX earlier, but this is a quarterly chart of the VIX, folks. And a lot of people don't look at quarterly charts. Me being a chart nerd, I do. And while this is we're only a couple of days, few days into the new quarter, right? So yes, this is a very bearish candlestick that we're seeing right here, right now. We have a long way to go before this quarter is over. And for anybody that joins in on our Thursday evening shows, I always say, one trading day left to go. Friday can make a big difference on the weekly charts that we review. And sure enough, this past week, Friday made a huge difference on many, many things, especially the 10-year yield. So the chart here of the VIX, to me, is clearly a cup with handle formation. We have broken out of a bull flag setup. We now have higher lows. All we're missing now are the higher highs. Now, I've been talking about the VIX mostly on a monthly time frame going back several months. And one of the primary reasons as to why I don't believe that the market has seen a bottom yet is because the VIX is never validated. The VIX is validated every major correction, especially a bear market, that I can ever remember. And I'll repeat it for those. I know a lot of you out there, you watch me constantly and you get sick of me saying this, but for the benefit of those folks out there, first time hearing, maybe it's the second time, you're confused the first time. The lowest we have ever seen a blow off top on the VIX, honestly, was back here in 1991 at 36. But in recent history, going back to 1999, it was 45.74. It only gets worse from there. This marked the bottom of the equity market back in 1998. Fast forward to the financial crisis. That was nearly 90. Fast forward to COVID. That was over 85. What was the most recent high? About 39. Hardly a blip on the screen. So this is why I do not believe that we've seen the capitulation yet that we need to wash out this market. And you got to add to that, we're still very, very overvalued. And even in 2020, we came close to being really fairly valued on a historical trend line, but we're nowhere near that yet. So I can't say that in the short run we are done going down, but all the stars are in alignment right here, right now, after this 20% rally on the Q since the June lows, to start putting on a hedge with volatility so cheap. Taking a look at the yield curve again, I want to acknowledge those folks out there who watch me every Thursday night, every Sunday night. Thank you. I love you. You're wonderful. I love the participation. Hit the like button for the dedicated viewers, and I appreciate you very much. But I have to repeat what I always repeat about the yield curve, folks. So far on the month, the yield curve has dropped 19 basis points. That's a huge, huge move. The bond market is clearly saying recession, but it needs an event. It needs a catalyst to break, to snap. What was it back in 2020? COVID. What was it back in 2006, 2007? The great financial crisis. What was it back in 2000? The dot-com bubble. Rinse, wash, repeat. So, what I want to draw to your attention is this inversion here. And it's a rather small inversion, but it was an inversion that happened rapidly, and it was a correction in the stock market that happened dramatically. And overlaid here in orange, typically this is blue, but tonight I have it in orange, is the S&P 500. And you could see what happens when you get a yield curve which then moves back up. It steepens. So right now, just because we have a yield curve which is inverting, that doesn't mean go sell your stocks. What you need to worry about is when the yield curve begins to steepen. That means things are starting to come undone, whether it be a freeze up in the credit market, whether it be an event taking place in the South China Sea. I don't know. I'm not that smart. But all I know is that I'm seeing a lot of stars align up here, and they're saying, buy insurance. The house isn't on fire yet, but goddamn, I see sparks. So this sell-off here, that was the taper tantrum of 2018. Most of this sell-off came in December of 2018. Usually that's an up month seasonally, very, very strong month. We were down roughly 20% in the month of December of that year. Why? Why did the stock market take it on the chin that month or in this time frame? I don't want to say it was entirely in the month of December. The reason is that the Federal Reserve, if you remember, was rolling off debt off of their balance sheet. And what they did in 3 years, the Federal Reserve has already done in 3 months in terms of raising interest rates. And if they commit to rolling off more debt off of their balance sheet in September and they follow through on that commitment, technically they've committed to rolling off debt dramatically already this summer, and they haven't done it. But there's one thing on this chart that is clear and defined. We are seeing lower highs and lower lows, nowhere near the amount that they promised they would reduce the balance sheet by. But the trend is your friend. We need to acknowledge it. And if they're going to raise rates in September, if they're going to continue to roll off debt off their balance sheet, that's another reason why. We have a Federal Reserve that is rolling off debt off their balance sheet. You have a federal government that is raising taxes into a recession that they will not acknowledge exists. Even the Federal Reserve will not acknowledge that we are in recession. You had 2 Fed governors come out last week saying that we don't think that we are in recession or that we're able to avoid a recession, and they're in denial. So you have a drunk captain at the helm of a ship and you have an iceberg immediately in front of you. So this is the reason why we are building, again, not a net short position. I still have trades on, but while we're doing a lot of market neutral trades using options, primarily options, we sell premium. We usually go out one standard deviation, maybe three quarters. One standard deviation is like 68% probability of profit. I like to generally go out about 75% probability of profit. That may sound all well and good and safe as a strategy, and it typically is. However, if you get a market that opens up and the bottom falls out, well, that one standard deviation is nothing, and the portfolio becomes in jeopardy dramatically. You have to manage it aggressively. Wouldn't it be nice if we had a layer of put contracts laid out there so that we're ready when the bottom opens up on the stock market, that we already have prepared cheap options purchased, so that allows for implied volatility to expand. Those options become more profitable. And of course, we buy deep in the money options and they become profitable right away because they're deep in the money. So they're what you call a 70 delta deep in the money contract. And we sell roughly a 20 to a 30 delta deep out of the money put contract to help finance it. So not most of it, about a quarter of the amount that we pay for the option is financed by the sale of another option. I know it's complicated, but it's really not. If I could figure it out, you could figure it out, believe me. So where do we want to look? Where is our safe haven? How are we going to hedge against probably a geopolitical debt event, a mixture of both? Well, we know that the BRIC nations are gunning for the US dollar. The Russians and the Chinese are directly looking to displace the United States, China, of course, in particular. Whereas the other BRIC nations, they don't really have confidence in the United States. They don't want to get bullied like we did the Russians. They don't want their FX reserves seized. We threatened India with that if they didn't comply with it, not selling oil or buying oil from Russia immediately after the invasion. So they're going to look for other opportunities. We weaponized the golden horse that we were given after World War II with the Bretton Woods Agreement. What's going to happen here in the coming years is our own fault. So we know that the federal government is not going to take the Reduction Act and they're not going to pay down debt. God forbid they ever do that. They're just going to spend it. So we know that for a fact. So what's going to happen to the US dollar? In all likelihood, it's going to decline at some point in time. On a weekly time frame, I got to say this, to be intellectually honest, you take a look at the US dollar on a weekly time frame. This is an outside reversal bar, also known as a bullish engulfing. Again, if you're new to technical analysis, 5-part video tutorial below, free, and it'll explain my top 5 candlesticks. So it appears as though what we're going to do is that we are probably going to get a move up. Do we take out the prior high here? I don't know. I'm not that smart. The market will tell us. I'll tell you this, though. If we do rally and we put in a lower high and we break to a new lower low above last week's lows, the dollar's done. Where do you want to be? You want to be here. Gold. Now, this is another quarterly chart. Now, gold has not had a good year. It was up dramatically earlier in the year, but last quarter, it took it on the chin. But if you want to take a step back and see what's really happening in the gold markets, you got to use a quarterly and monthly chart. Stop with the daily charts. God forbid you're using intraday charts to dictate where you think gold's going to be for a year from now. Stop, please. I beg of you, don't use those charts. Way too much noise. You need to use a smoothing mechanism. What's a smoothing mechanism? Quarterly charts, monthly charts. So what do we have here? Well, we have a bull flag setup on gold. And we broke out of it in January, the January quarter. Remember, this is a quarterly chart. Last month, what did we do? We pulled back. We tested the breakout point. It was a bloodbath of a quarter. I think I just said month. Last quarter, we pulled back. We did a retest of the breakout point. It held. That is bullish. Even though we were down, that's a bullish event. This quarter, what have we done again? We retested what was resistance, is now support 2 quarters in a row. If we turn green here, actually white on this chart, if we turn positive on the quarter, you could very easily see a breakout to new all-time highs within the next 2 quarters on gold. And if the US dollar rolls over and you ever hear about the Chinese backing the renminbi with gold, you're going to see the price of gold shoot up overnight by, I don't know, several $100 overnight, like that. And the gold mining stocks, they're going to go much higher. And the only reason why the gold mining stocks haven't gone a lot higher is because, yes, there's been dollar strength, and they've also had their input costs, diesel fuel costs, major input costs for the gold mining stocks. That's gone through the roof. But when you take a look at a quarterly chart of the GDXJ, we have a bullish key reversal way too early in the quarter to say that this is a done deal. We're going to close up on the quarter, but this is looking very promising. GDXJ looking good. And even if you want to drill down further on gold, you want to take a look at a monthly chart. We are at historical support. We closed down last month, but we rallied off of support immediately below, closed above another support level. This is why we like the gold trade, the silver trade. And I think that is it. Let's go to comments. Yeah, I think we have time to do coal. Jim Creamer said last CPI. I can't read it. I got this pop-up that's in front of me. Oh, there it goes. Said CPI was the last bad number. Yeah, the last bad number for maybe a couple of months, but not. Nobody really believes that this CPI report coming out this month is going to be all that horrible. I mean, take a look at the price of oil. I think that price of oil is now, and this is since June, down 31%, over 31%. So to think that oil is not going to have a major impact on the month over month CPI report, not necessarily year over year. It's probably still going to be higher than last year, but the month over month, it should come down this month versus the prior month. And they'll probably do it for August, September as well. But then oil is going to catch a bid and it's going to move back up again. Let's do some chart requests. I was messing around here, so I'm going to go back to the indicators, take some off. For you options traders out there, I'm messing around with a new format for trading options using TrendSpider. Folks, if you're not familiar with TrendSpider, automated technical analysis, link below. Take a look at their video tutorial of what they offer. Great company, 35% discount code below. For options traders out there, they have historical volatility ratio, very, very good stuff. And they have more options indicators coming on board as well. So let's go to I don't know if I could bring up the commodity coal on here. I think I need to use at a spot price. I need to use yeah. They don't have that's weird. They don't have a continuous contract either. So what we can do, we can look at Arch Coal. This is a monthly chart. I like the monthly chart. We're down on the month, but we're popping off of the 20 period moving average. So this is looking good. Let's take a quick peek at implied volatility. Dollar's firming. They're going to rally it. They're going to rally the dollar. Son of a bitch. Let's bring up Arch. The options aren't that expensive, so I like to sell options. So I want expensive options to sell. So the options are not that expensive. You could, if you're interested, you could still sell naked puts close to the money if you want the shares. So on a monthly time frame, it's looking good. Weekly time frame looking good. The automated trend lines are picking up support below in green. And if we look, yeah, you can see implied volatility is coming off, making the options cheap. So let's see if we can open up a debit spread here with calls. So I'm going to go to a daily chart. I wouldn't do it. Too much overhead supply here. Me, I'd be looking at selling premium at around the 115 strike price. And if it gets assigned to you, good. You're going to be getting the shares right at a support level. Okay. So our alert is set. Yeah. So here's the value of, on the daily chart, I just overlaid weekly support and resistance. And you can see that immediately above in dashed line on this daily chart is weekly resistance in blue, weekly support in green. So we are sandwiched in between two resistance levels on a weekly time frame. So me personally, I would sell the puts here and I would average down my basis cost. What if it doesn't come down and your puts don't get challenged, they don't get put to you? No big deal. Wait for a breakout above. Oh, this is the VWAP. This is not weekly resistance. It's weekly well, actually, it is weekly resistance, but it's a VWAP, volume weighted moving average. I can create an alert there. And we're good to go. So our alerts are set here. Me personally, I would sell the naked puts. Too many people still don't see the coming collapse or care. We have liars in government. I mean, and they believe their own BS. They believe it. You think government create the problem? Wait till you see the solution. Yeah, tell me about it. 36 watching, only 13 likes. Please smash the like button. Thank you very much, Paul M. Carried interest provision for hedges. Yep. And that's Kristen Cinema. The warrior of the common folk went to back for private equity. Yep. Schmitha is September 25th. I don't know what that is. Could be a crash you are expecting around that time. I don't know what that is. I probably should. Nancy Pelosi took her son to Taiwan. Oh, really? That illustrates. I don't know what Seymour. You gotta explain that one to me. Yep, it's all the central banks. When will the Fed pivot and why? They need a crisis. Yeah. So you take a look at the economic data, which is coming out weak, and the market has priced in a pivot, and this is the problem, right? You had initially a market that was oversold; it needed a rally. All that's great. Okay, it's expected. The most ruthless rallies happen in a bear market. Everybody knows it. Everybody's heard it. But around here, when we hit resistance, economic data kept coming out negative, 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 negative. So that builds a sentiment. And the sentiment is that the Federal Reserve needs to pause on aggressive interest rate hikes because we already had 1 quarter of negative GDP, probably going to have a second one, which we got. We're in recession. So once we get that, you have the markets that price in. Okay, they got to pivot. But if you're listening to what they're saying and what they're doing, they're clearly not ready to pivot. And that's the reason why you got to get worried about another leg down in this market. So I think that you need to answer your question, whether it be a credit crisis, whether you have a Lehman moment, whether it be the South China Sea. I'm worried about the South China Sea very, very much. We're a great country. I love my country. I really, really do. But our representatives are clearly, and I'm talking about Republican and Democrat, are clearly corrupt, and they're causing this country to go into decline. PLTR earnings, yes, Patrick said that as well. Thank you very much. Appreciate that. He's a creamer. No, he's not a dreamer. PLTR. PLTR. What did I just do, dumbass? It looks good. It looks good going into earnings. Nice solid base. We are above a volume shelf at current, but this is a monthly chart, still early in the month. Weekly view. We broke out last week. Expect a retest. Of course, we have earnings tomorrow morning. Really, this chart could look a lot different tomorrow. So, X earnings, if it weren't happening tomorrow, I would expect a retest of support at $11 per share, and I'll be looking for a continuation move up higher. Daily view. We broke out on Friday above upper band of resistance, as noted by the automated trend lines. Palantir looks bullish. But again, earnings tomorrow. RNG. Ring Central. Still under a lot of pressure, but you're seeing, oh, this is interesting. Take note of the implied volatility on the options is on the rise. IV percentile at 45%. Still not expensive enough for me to sell the premium, but they're rising. Once that IV percentile here gets above 50, then I would be willing to sell some options on it. Right now, what we're doing is we're holding this VWAP, the lows of last month. Weekly view. You have a lot of resistance above here, a lot of it. You need a really good, strong day. And we need a close above. Give me a close above 60, and it becomes very interesting on a weekly time frame, not a daily time frame. On a weekly time frame, on Friday afternoon, 3:55 in the afternoon, if we see implied volatility rising, it's actually moving lower on a weekly time frame. But if we see weekly volatility rising and we close above $60 a share, I'd be willing to open up a trade on Ring Central or just buy the common stock if implied volatility doesn't move up. Daily view. Yeah, you see, I have a lot of sellers here. We broke out here on August the 3rd, and then we broke back down. That's pretty bearish stuff. So you have a lot of resentful buyers back here. They bought, I call them zombies. Other people call it overhead supply. Uh, they are pushing the stock down. You need to get a good close, ideally above $60 a share. And if you want to do this on spec, you get a close above $49 per share. That would be a breakout on a daily time frame. In fact, let's set this up. No sensitivity. All I care about is a close above that resistance level. And we want to break out. We'll keep this active for a while. And we are good to go. That's ring. How far out on Q puts? They expire, I think it's the 16th of June, 2023. Very, very far out. I didn't want to. One of the big mistakes that people do is that they buy options that are too close in expiration, and once you get past the 45-day threshold on an option, time decay really begins to ramp up. So I went out way, way, way out of. I bought deep in the money. I sold deep out of the money to finance it. But in terms of expiration, I went a long ways away with very, very minor time decay on a daily basis. So I could carry it for a while, very little time decay. I can go out probably 3 months and just minimal time decay. What else do we have here? I know Larry asked for one in the members area. Oh, Tupperware. Uh, Tupperware looking really good. We were long on this a while ago. It had a great setup. The setup just didn't follow through. I was back here, and it fell apart. It's looking good. Tupperware weekly time frame. We broke out last week. Watch for a retest down at. I'll give you the number in a second. Touch, bounce. Volatility is rising. That leads me to want to take a look at premium. No, it's not there yet. Daily view. A little bit extended. You have resistance. Again, the automated trend lines. What a time saver. Automated trend lines telling you have your resistance immediately above. We're also flirting with the third standard deviation Bollinger Band, and that's a bit of a problem, right? So we're a little bit extended. For those not familiar with what this line in red here and what a Bollinger Band is and what especially a third standard deviation Bollinger Band is, I'll save you the technical jargon. We're not supposed to be there. So allow for a pullback. I think we're going to probably pull back to 933, 950 per share. and that'll be an opportunity to get long of Tupperware. I like the trend. We are beginning to move up higher on a daily, weekly, monthly time frame. Tupperware looking good. Pages run the world. Pedos. I'm thinking Pedros. I'm trying to think about pedos. Yeah. Smallest negative GDP in history, probably. Okay, it's a negative GDP. It's recession. This is again with the I can't even say it. Shemitah. Is that accurate? Shemitah. End of a 7-year cycle. All debts forgiven at the end of the. Oh, okay. It's Jewish. Okay, I understand. Now it makes sense. Kramer is a partisan cheerleader. Yes, especially for Salesforce.com. His credibility was sold to the highest bidder long ago. Do you not take him seriously? Insane in the membrane. Yep. I don't even watch him. All right. Take your word for it. I want to buy some SQQQ. What is a good price zone? Uh, well, if you're going to buy the SQQQ, that is a leveraged product. Therefore, you have time decay. So you need a confirmation that a breakdown is about to happen. So, and you're going to be putting a lot of capital to work. I could have bought the SQQQ, but you have time decay there as you do on the options. But it also, if you're using a margin account, that's 50% margin. It takes up a lot of buying power. So before I purchase the SQQQ, which I've owned in the past, I will probably own it in the future. You need a breakout. And I would look towards a weekly chart. I would look for a close above 45 bucks a share, and that'll probably be the beginning of a sell-off on the Qs. Stokes are declining. They're trading down below 50. I would not chase a rally here. You need to wait for a breakout and a close above 45 bucks a share and allow for these Stokes to flatten out and hook back up. I would not use a daily chart. You got to play the long game here. Where's our support below? We have support down here. If this thing gets down to 23 bucks a share, I would be a buyer there as well. If you want it right now, sell naked puts, play with it. I just wouldn't buy it right now. Even though I'm putting on a hedge. I'm not negative on the market. I still think it can go up. That's the reason why I'm not buying the SQQQ. If I thought tomorrow the market was going to break, I would buy the SQQQ. I'm not doing that. How do you like CF target 117? I like it a lot. So what we did here, take the automated trend lines off. Now I'm going to put them back on. We broke out last week. So where TrendSpider is saying we have resistance is immediately above at 118.08. So I think that you could very easily hit that 117 price target on CF. Looks good. Better to buy SQQ too early than too late. If you miss a sell-off, you'll never get in. No, sure you can. Sure you can. It's the options. It's the options that'll get you. You do not want to go buying options when the bottom is falling out of the market. They're too expensive. So SQQQ, you can still buy. You don't have implied volatility expansion there. You're welcome, Franklin. Talk to you tomorrow. Is end phase overbought or will it keep going. It's overbought relative to its third standard deviation Bollinger Band. That doesn't mean it can't keep going. Volatility is rising here. Not enough to sell premium. I think it's going up higher. Despite the weekly chart, where we're flirting with the 3D Bollinger Band, the daily chart is saying, yo, we want to go up higher. Because you broke out on Friday. Price target right up here at around, wow, this could have a good move, 258 possibly. But just keep in mind that weekly chart is overbought on Bollingers. Don't stay around too long. I just walked through lows too on. I'm shorting lows tomorrow. I love observations like this. I just walked through lows too in Orange County, California today. I'm shorting lows tomorrow. This looks dismal. What did you say? What was your observation, Falcon? Thank you for sharing. Thanks. I was thinking some leaps on SQQ out to next year, first quarter. I was thinking the same thing, but my concern was, again, is the time decay on the underlying. So I didn't want to remember what you're trading on SQQQ is you're buying a derivative product based on options. So if you buy an option on an option, you know what? That gets a little bit too overly complicated for me. And if I don't understand it, that becomes a problem. So I would prefer just using the Qs and having my hedge out. And that way, if I can't sleep at night, it's not worth trading. So that's why I went with the Qs. I'm not saying you're wrong. I would just do a little bit more research on the time decay and what influence it could have on your option trade. Again, with the debts are forgiven, but must be paid off by servitude to the one who forgave. Gotcha. Bitcoin. Yeah, we're going to go over that because I own it. I'll be buying more tomorrow on my dollar cost averaging. You're welcome, Henry. Okay. Yeah, we'll leave it off with Bitcoin here. And then I'm going to eat some ice cream because it's hot as hell. Bob's awesome. Thank you, Yoga Matt. You're awesome too. Thank you for being here, as always. All right. So Bitcoin, I own it. I own a very little amount. I dollar cost average $50 every Monday. So it looks as though we want to break out of this bull flag setup. But the thing to keep in mind here is that if we roll over on equities, Bitcoin's probably going to follow suit because that's just been the trend. Bitcoin is traded with equities. When we sell off, Bitcoin sells off. When we rally on equities, Bitcoin rallies. So we are what? 41% off the lows. It's a heck of a rally, but it looks as though we want to break out more here. Falcon, where you have one of the richest counties in the United States, no doubt, Orange County, and there is scraps on the show. Oh, really? So they have no product. Oh, boy. Okay, thank you for that. Thanks, Bob. First time on here. Love the direct Q&A. Joel, thank you for being here. Welcome back anytime. We do this again on Thursday night, so please join us. Hit the subscribe button and the bell button to get notified. And we have a video tutorial below. My top 5 favorite candlestick patterns, free. Folks, thanks for being here. You know what? I'm going to check back in with the futures. I promised to do that earlier. Let's see what's going on. I didn't have any alerts fire off. And we set up a bunch. So we'll leave it off going through the futures action. You're welcome, Pat. Best of the family, pal. Say hello to Artie for me. I will still keep buying Bitcoin. Yeah, me too. It's worth to have a taste of it. Not too much, but a taste. All right, the NASDAQ. We are now down So we've weakened up since we began the program. Not a tremendous amount of selling here. We are off the lows, down about a little over a third of a percentage point. S&Ps, they're down nearly a third of a percentage point, consolidating. Let's check in with the dollar. The dollar's stable. We'll leave it off with gold. Gold down fractionally. You know what? Let's continue. I want to see if there's a change in FX. Euro trying to go green, but still down fractionally. Yen up. The yen has turned positive. Let's go to the weekly chart of the yen. No new weekly low or low. And we'll leave it off with, I don't know, the VIX. The VIX is up nearly 1%. This is a weekly chart. Let's drill down to a 15-minute chart. Struggling on a 15-minute time frame. So while equities are looking weak here at the open, the VIX is not looking all that strong itself. It's up, but not doing what you would expect it to do. So with that, folks, everybody have an awesome trading week. Let it be profitable, be tenacious, and use stops. Talk to you soon. Be well.